Hello, this is Group 1. Now we will present our project, which is ESG score and the stock price in China. Here is our agenda. Then we will go through these 6 parts. First, let me make a short introduction about ESG, which includes environmental, social, and governance, which is essential for businesses to achieve sustainable growth, risk management, and long-term value creation. Key focus areas include carbon neutrality, ethical supply chains, diversity, and transparency. So we chose a research paper and replicated this SSCI indexed paper in 2023, which investigates the impact of ESG score on stock price in China's A-share market. So the paper is indexed as follows. Then we make a short comparison between the paper and what we did. For the data, the paper used the stock data from 2017 to 2020, which is 3 years before the breakout of COVID-19. And we use the stock data from 2022 to 2024, which is after the COVID-19. So we could measure the impact of COVID-19 to some measure. And for the models, besides the FEMA regression, which has also been used in the paper, we also tried other models like Bayesian regression and the panel fixed effects model. For the findings, we generate the similar findings, which is firms with higher ESG scores tend to generate higher future excess returns. And here is the main variables we used, such as the ESG score and the individual score, and some financial variables like monthly returns, market equity, firm size, book-to-market ratio, turnover effect, liquidity effect, and a stock sensitivity to the overall market movements. And then based on these variables, we make a data description, and this is the statistical values. And we also generate a correlation matrix to show the variables correlation. And we found that ESG score exhibits strong correlations with their individual components, and that makes sense. While financial variables such as the stock returns, RET, and the firm size show weak or negligible correlations with ESG metrics.
So we apply the FEMA-Macbeth regression to test whether the ESG scores lagged by one period can predict excess returns while controlling for traditional asset pricing factors. Our dependent variable is excess return, and independent variables are previous periods, ESG scores, and FEMA French 5 factors. These 5 factors focus on market-wide effects rather than the individual stock characteristics. So we have market risk premium, and SMB compares small cap stocks versus large cap stocks, and HML compares value stocks versus growth stocks, and RMW compares high profitability versus low profitability firms, and CMA compares low investment versus high investment firms. We also have other control variables describe individual stocks characteristics, helping isolate the effect of the ESG. Beta measures how a specific stock moves related to the market, and firm size, book-to-market ratio, and growth profitability, and asset growth, and short-term reversal, and also have momentum effects, and turnover rate, and illiquidity ratio. Then we ran the FEMA-Macbeth regression. We noticed that the model is statistically significant, and the lagged ESG scores has a coefficient of 5.77 with a p-value of 0.0382, confirming a positive and significant relationship between the ESG scores and the future stock returns. However, we also found some issues when examining the rolling regression coefficients. We noticed that the CMA and RMW have extreme volatility. It may due to our limited data sample, which only have 2 years after the COVID. So they are highly correlated and distorting regression coefficients. Besides, the Feynman-Macbeth regression is influenced by extreme returns leading to unstable estimates. Thus, we switched to Bayesian regression. This model works well with small beta samples and shrinks correlated factors effects toward reasonable values and less sensitivity to outliers. So this is more suitable for our datasets. Here is what we found. 94% of the highest density interval is above 0, confirming a statistically significant result. The mean ESG coefficient is 8.5, meaning a higher ESG score leads to a better future stock performance, which has the same result as before.
So building our foundation of replicating the methodology from a reference paper, we shifted focus to develop our own optimized model for predicting stock returns, which is presented as RET. Our goal was to rigorously test whether machine learning model could enhance predictive accuracy while isolating the role of ESG factors. Well, here's how we approach this. Our first step is to conduct the EDA and feature pruning. So we began with a comprehensive EDA to understand the dataset's structure, distributions, and potential outliers. Well, variables with low variance or negligible correlation to RET was removed to reduce noise, such as the stock name, stock code, listing date, etc. While outliers, particularly extreme values in financial ratios like BM and the book to market and illiquidity, were winsorized to ensure the robustness. So this step streamlines the data set, retaining only the most theoretically and empirically relevant features. And then we train a baseline random forest model as our starting point. The feature importance results were striking. As you can see, the market and liquidity factors dominated, while turnover rate and illiquidity emerged as the top predictors, followed by book-to-market ratio aligning with the classic asset pricing models like FOMO French. While ESG scores showed moderate importance. Whether its overall and its components ESG respectively ranked above beta and industry classifications, while they are overshadowed by liquidity and the valuation metrics. So this suggests that while ESG perform plays a role, it is not the primary driver of returns, which is a finding consistent with finance theory, but leaving open questions about its specific economic impacts. To dig deeper, we apply the SHAP to the random forest model, so the result reinforced our initial findings. As you can see, the liquidity and turnover ruled in the situation. They had the widest SHAP value ranges, confirming their outsized influence. While ESG factors show some impact, their effects varied widely across stocks, suggesting that context-dependent relevance, for example, the ESG might matter more in certain sectors or under specific market conditions. And SHAP values for industry classifications cluster near zero, reinforcing that stock returns are driven by firm-specific factors rather than the sector trends. To ensure we weren't missing a better machine learning approach, we leveraged PyCaret's automated pipeline to test over a dozen models, including the gradient boosting, LightGBM, and Bayesian Ridge, and of course the best performed model dummy regressor. Despite the extensive hyperparameter tuning, we see all models exhibited low R-squared values, which are basically negative values, indicating that weak explanatory power. So this was a critical insight. While machine learning could identify correlated patterns, for example, the liquidity's dominance, it failed to provide a theoretically interpretable framework for isolating ESG's causal or incremental impact. Given the machine learning's limitations, we transitioned to econometric models to rigorously test ESG roles. For example, we need to control for dominant factors such as the turn, the ILIC, the book to market size, and also the market equity. They were prioritized as controls, reflecting their strong predictive power in our machine learning results. With this foundation, we will now apply the panel fixed effects model to quantify ESG's incremental effect on RET, while ensuring our conclusions are both statistically sound and theoretically meaningful.
Here, besides of our model that we choose FEMA MacBeth as our model, we just want to compare whether there's a better model or not. So we just use this panel fixed effects model as our comparison model. The key points for the panel fixed effect is that it treats stock code and months as dummy variables so that we can just say it compare it in different areas. And secondly, the benefits of the panel fixed effect is that it examines whether ESG score at time t have a predictive relationship with stock return at time t plus 1. And the advantage of panel fixed effect over FEMA MacBeth is that it is better control for unobserved effects, account for both firm-specific and time-specific unobserved factors. And the second advantage is that it just saves our time and it is more stable to predict. Here is the dependent variable, independent variable, and control variables for my model. The model, as you can see here, it only treats the ESG scores for independent variable, and the dependent variable is always the same for excessive return. And the other variables are all treated as control variable. And the output is showing here. As we can see from the final output here, the ESG standard score for the coefficient is positive, which means that the higher ESG investing strategies, probably the higher future excessive returns. And the p-value showing here is indicate a somehow statistical insignificant, also support for our report.
Let's make a conclusion for our key findings. Our research reveals something quite compelling. Companies that take environmental, social, and governance factors seriously tend to perform better financially. This isn't just good news for sustainability advocates. It's valuable intelligence for investors looking for an edge in the Chinese market. We tested this relationship using several statistical approaches, FEMA regression, Bayesian model, and panel fixed effects. All confirm the same pattern. Higher ESG scores correlate with better future returns. Interestingly, we found that market liquidity factors like turnover and liquidity remain crucial predictors for stock performance. This suggests ESG score isn't replacing traditional metrics but complementing them to give us a more complete picture. What does this mean in practical terms? For investors, ESG scores offer a new lens to identify promising long-term investments. For companies, improving sustainability practice isn't just about reputation, it directly affects your bottom line. And for policymakers, promoting ESG transparency makes both environmental and economic sense. Looking ahead, we are eager to dive deeper into the individual components of ESG, tackle data standardization challenges, and see if these patterns hold in other markets. Thank you.